Hello friends, welcome. Friends, the US inflation numbers are also out, and yesterday the Indian inflation numbers also came. The difference is that US saw a higher than expected inflation and India saw a lower inflation, right? Which is 4.31. So people were very happy. That's why RBI probably foresaw this and therefore they have done a rate cut. But in US, the situation is completely reversed. Because if you look at this chart which I had created earlier and I've shown you in one of the videos, you will find that the inflation, the real inflation is shooting up. And now this real inflation number it was in December 2024 was 2.87, which is 9%, 2.9%. Now it is 3%. So this is one thing which is a cause of worry, and we will discuss why this is a cause of worry, right? And what kind of impact this is going to cause on India. And we'll go step by step. First, we will talk about what is the reason for a worry and how this number can further spiral bound and become worse. If that happens, then there will be a large impact on countries like India, because we are directly dependent upon what is happening in US. Why we are dependent upon that? Because there is a large amount of capital which goes into countries like India, which is withdrawn when the inflation in US rise. In the process, the expected bond yields of 10-year also rises. Means the real bonds of 10-year bonds, which is having a direct correlation with expected inflation, is rising. So people are interested in investing in bonds of US, a 10-year bond or a higher duration bond in US, because they are getting a better yield compared to what they are expecting from India. So therefore there is a capital flight. Directly there is a capital flight. So in this video we are going to weigh all these risks, and we will see that what kind of further risks that exist, right, due to this phenomena which we are seeing in US, right? And if inflation continues to increase and the 10-year bond rates become much more compared to what normally it was in the past, how India can mitigate this risk and what kind of risk that India can see going forward. Now, friends, you all know that in India, we have been harping on reducing rates, because the rates, if the rates gets reduced, when the RBI reduces rates, then it has direct bearing on many dimensions. First and foremost is that the government interest payments are obligations are reduced, because the short-term bonds and the mid-term bonds are directly correlated with the RBI rates. So if lower the RBI rates, the lower the interest rates for short-term and long and mid-term bonds, not long-term, because long-term is driven by expected inflation. So that happens. What happens is that because these bonds soften, and therefore when a government of India borrows short-term, mid-term, they end up paying less interest. So their overall interest payment obligation actually reduces, which is a large proportion of the overall budget, right? Which we already saw. It is actually more than what the government is spending on capex, right? So that is one of the major points. The second is that the RBI's ability to drive interest rates down depends upon what? Our own inflation. Because if our inflation goes out of control, then what will happen is that RBI will not be able to reduce rate, because containing inflation is one of the major objective of RBI. So if that happens, then what will happen? That this will be the last rate cut that we are going to see, and there will be no further rate cut that we will be seeing in the future, because whatever rate cut that we saw is very marginal, because it has just reduced the repo rate from 6.5 to 6.25, which is not going to have a huge impact. So our rate cut decision depends upon what is happening in US, right? Which we can clearly see from here, that the US, the Fed in US, which was trying to reduce rates, are no longer going to do so because of this 10-year bond rates yield, which is getting more and more with going forward. Now, friends, having set the background of this discussion, what I am going to do is I am going to take you through the CPI charts. CPI means Consumer Price Index charts, which I had created, and give you a flavor as to what kind of risk that we see from a further worsening of inflation in India. Because that's what is the main part of this discussion. And this intertwines with the fact that there is a capital outflow. Now, before I take you through what kind of risks that we see from our inflation continue to remain high, I will like to show you how much capital outflow we have seen till the time the data is available. So if you look at the one of the charts which I will show you, which is I have been tracking. So this is the RBI stable number 34, which gives you foreign investment inflow in dollar billion. So this I have plotted on a yearly time scale, and you will see that the numbers have peaked till FY 2020, and then it has actually FY 21, and then it is dropping. See the net foreign direct investment, and in FY 2025 the numbers are till third quarter, and the numbers are pretty bad. It is hardly any foreign investments which have happened in India. So the net foreign direct investment numbers have gone down significantly, but there is a solace that there has been some, you can say, repatriation and etc. These are not, these numbers etc. No, there is some investment which has happened in portfolio investment. So total foreign investment outflow, if I plot this here, you'll find that this is not so bad, but it is significantly bad compared to what we saw in FY 24, because this is the total foreign investment. A plus B means direct investment plus portfolio investment. Still it is pretty low, right? And that is the reason why we are seeing our rupee under pressure. You see that the rupee is under pressure because of this outflow. This is under pressure because the funds are going to US, because there is a direct hardening of 10-year bond rate in US, and people are investing in US to have a safe haven, and funds are being withdrawn from countries like India. Now let's look at the main part of the video where I wanted to give you a sense as to what kind of inflation risks that we see going forward. Now friends, I really don't have the data which RBI has, right? I have data which has been presented before the public domain, and we are going to look at that data only to predict what we are going to see from an inflation point of view going forward, right? And we will also, you can say, correlate that with the survey which RBI does with the general public, and that data also RBI publishes on a regular basis. So we will correlate both the data sets and see what kind of risk that we are seeing, because survey tells us that what the common man feels about inflation going forward, because that's a very good indicator what will be the kind of inflation that we are going to see in future. So first, let's look at the number, what you called let me just see where the chart is. Just a minute. There is a chart which I actually had extracted out. Let me just see where the chart is. Just a minute. Let me just pause the video and I'll find the chart. Just a minute. Yeah. So this is the chart basically I was talking about, right? Which RBI keeps on publishing, which gives forward-looking survey. So this table is called product-wise expected price for 3 months and 1 year ahead, percentage responded, right? So what this chart is telling you is that there are various category options, general, cost of services, food product, etc., that you can basically pick from this drop-down box. And then you can pick items like product 3 months onwards or 1 year onwards, right? Product wise. So I have picked 1 year onwards, and you can pick a time frame, month, quarter, and yearly, and the number of time minutes that you want to display. And then this is basically to move the chart backward in time. So let's the chart get refreshed. So let me just again, put. I think there are 6 set of charts. So I'll just take to the next visualization. So which was the visualization which I was talking about, the next one, because that gives the story, right? No, not this one, the previous visualization. Let me see if this is correct. The previous visualization, let's see if it is correct. Yeah, this is the visualization. Now, if you see here, so there are different rows here, right? One is price increase more than the current rate. Then says price increase similar to current rate. price increase less than current rate, no change in pricing, and declining pricing. And these are all going to add up to 100, right? These columns are all going to add up to 100, right? So if you see price increase more than the current rate, right? And if I choose 24 months period, so as to give you a better trend, you will notice that for the general index, for product 1 year onwards, you see that there is a rising trend, even in the month of January. So people are expecting a higher inflation more than the current rate. And people who are expecting prices to remain same are kind of low, going down. See, 18.1%, right? Price increase less than the current rate is also going down, right? And there is no change in pricing, also going down. And decline in pricing is also going. So you can clearly see that the respondents which are responding to RBI survey clearly see that the inflation is not going to get contained, and for general items there is a rising trend, the survey shows. So this is one indicator that inflation is not, we are not out of the woods. The second thing that is pretty important, which is looking at the data and try to unlock the story. Okay, so let's look at the data. And this data I actually have aggregated using the RBI's, Ministry of Statistics, the data that they keep on publishing on a regular basis. Now here, what I have done is, if you look at this chart, what I have done is that all the subcategory items, I can pull down from a drop-down menu. So this drop-down menu, using this drop-down menu, I can pull all the subcategory items. For example, I can choose cereal and product, I can choose clothing, I can choose eggs. So all the subcategory products I can choose. And here I have plotted what I plotted. I have plotted the years and the months. And this is nothing but, what is this? This is the combined index. So let me just show you, show filter, and you will see that I have chosen combined index, not inflation. Because index is the very good reference to see how the prices increase. Because as this is like a mountain, right? You go climbing a mountain. So this is like all the slopes, and then you're climbing a hill. So as you climb higher and higher, means that whatever price that you are seeing here at the top of the hill is actually at the reference of 100, which you saw at the beginning of the hill. So if you compare the price from here till here, that is going to give you how much price has increased starting from FY 2013, because this is FY 2013 year and this is FY 2025. So when you calculate inflation, what you are doing is, you are basically doing what? You are taking the index, right? For example, if I want to calculate inflation for the month of December, so then I'll take the index value for FY25 for the month of December, and then I will take a corresponding, index value for the month of December for FY24, and then subtract that and see how much percentage the index has increased in the month of December for FY25. That's how the inflation is calculated, because it is seasonal in nature. So you are calculating inflation like that. So friends, what we are going to do is, we are going to check each and every individual item and see that which item actually kind of going to risk inflation. Because there are certain items which are going crazy, haywire, and there are certain items which have a very steady increase, and there is no risk for those items to have a larger contribution to the overall general index. Because if you recall, friends, I showed you one chart, which is this particular chart, which is posted in my website, which has combined, inflation weighted average here, which you, from a drop down menu, you can choose. And if you see 431 here, whatever 431 number that you see, it is a percentage basis point. And instead of capturing actual inflation, I have captured the weighted average of these items, the subcategory items, the contribution to the general index, the general inflation, which is 4.31. I have chosen 431, means if you add everything together, this will come out with this this value. And why inflation of these individual category items is different from weighted average percentage basis point? Because every item has got a different weight. Because it has got different weight, therefore even if the inflation of a smaller weight item is pretty high, for example sugar and confectionery, if it is very high, because the weight is so low, its contribution to the overall inflation will be low, right? But if there is an item which is moderate from a weight point of view, like vegetables, but if its inflation is pretty high, the indexes are pretty high, then its contribution to the overall inflation will be very high, right? So that's how I basically have explained this in the earlier video, in one of my video. So what we will do is, because we have seen here in this chart that vegetable has been the main bone of contention in driving our inflation, which we have seen. Because if you look at this, the vegetable in the past December 2024, it is 160 basis point. Whenever the inflation was low, the vegetable contribution was pretty low. So this time the inflation is low because the vegetable contribution is only 69 basis point, right? So if you are able to contain vegetable inflation and other items stays constant, then we will largely be able to contain inflation. That is the essence of what emanates out of this discussion. That's why I have created this chart. So what I am going to do is, let's go straight. So I have chosen combined index, right? Because it's for both for rural and urban. And I will basically go and choose vegetable. Now you will find a very strange phenomena here. What are these? These are years, which I told you, right? These are all years. Yeah. And these are months. So vegetable is likely to have a seasonal effect, and these are all weights, by the way. Start from 100, and now at the top it was 292, right? And it has dropped in the month of January to 217.8. There is a sharp drop here, and that's why the contribution that you saw was 69 basis point to the overall index. Now friends, what you make out of this? This chart is so haphazard. There is no seasonality which you see here. Why I am saying that? Because the peaks are not consistent. Because this peak that you see right here, this is in the month of November. This peak in the month of August. This peak in the month of September. This is July. These are two peaks, August and then November. Here there is a peak in August. Here the peak is actually in the month of December. Here this is October and November. This is November. This is October. This is July. There are two peaks, July, and then there is a dip here, August, and this is October. So friends, and now there is a dip here in January. Now whenever we are calculating vegetable inflation, we are taking the number, the index number, which is right here in the month of January here, whatever the number is here. This number was how much? This number was 217.8. And we have to see the corresponding value in the earlier financial year for the month of January, which was how much? 195.6. So if you see this from here to here, just see this from here to here, right? This value. So if you look at this and if you look at this, right, though it is actually not at the same peak, therefore you can't compare these two peaks. Ideally, if it was truly seasonal, we should have been able to compare peak versus peak, trough versus trough. Then there would have been some consistency in the vegetable inflation, which is not the case here. Can you see that? There is no way you will be able to tell whether the vegetable inflation is going to go up and go down, because there is no consistency and there is a base effect which comes into picture. So given a situation like this, should we be happy by looking at what we are seeing here as 4.31% inflation? That's the question I want to ask you, because vegetable is the major contributor for inflation. So if we are basically seeing a vegetable inflation, driving our overall general index inflation to such a manner, that is impacting RBI's ability to do rate cut, because our inflation is a basket of commodities. And if vegetable is basically rising the expenditure of a people and putting stress on their expenditure, should we not pause before we even think of doing further rate cut, because that is going to drive our expected inflation further, and in the process the inflation will go out of control. And if you look at this similar chart which I have prepared, like what we did for US, you say that the India situation, India's policy rates are plotted here, the inflation is plotted here, and the bond rate yields are plotted here. Now you will see that how the short-term bond rates are getting impacted by the policy rate. The policy rates are low, the short-term bond rates are low, and then the long-term bond rates remain unchanged because of the policy rate. So It all depends. So there are two battles which we are fighting in one single front. One is local inflation, which has got a direct bearing of the imported inflation because of rising cost of rupee, rising devaluation of rupee, rising cost of import, because of driven by the US inflation. And locally we are fighting the maybe the supply side issue, not able to manage vegetable supply, lack of cold storages, I don't know. Maybe because of that we have not been able to handle vegetable inflation, which has become a significant part of our, which you can't do anything unless you have an infrastructure to store vegetables in cold storages and then dump them at the time when the price has increased. You can't do that. You can do it for cereals, but you can't do it for vegetable. So given a situation, we are in a very difficult situation, friends. One is that US is going to get further worse because of Trump's policy of raising tariffs. And then, with tariff getting raised, the cost in US is going to increase, their inflation is going to increase, their bonds are going to get further hardened, the capital flight is going to take place from India to US, and we are not going to be dependent on US investment in our market, and we have to be largely dependent on domestic investment. And we need our rates to go low, and we need to drive our rates low only if our inflation is contained, and our inflation cannot be contained because we are importing inflation from US as far as rupee rates are getting depreciated. And on the process we have a supply chain issue because we can't contain vegetable inflation, which is going haywire, and it does not follow a cycle. It does not follow a cycle. You see this? And if it does not follow a cycle, then how can you predict that if you are seeing a lower inflation here, like in this chart which I showed you, right? If you are seeing a lower inflation here of vegetable, how can you say that this is going to sustain in the near future and we are not going to see a higher inflation? Friends, do you get it? What kind of problems that we are facing in our economy? So friends, that's what I wanted to tell to the viewers, a story which is intertwined. All the data sets have to be intertwined with each other to see the larger picture. You can't see the picture with one single isolated number. So friends, I hope that you probably have understood what I'm talking about, what kind of risk that exists in our economy, and how our economy is dependent on the US economy. If something goes wrong in US, India is going to get impacted, right? Because of our large dependency on imports of goods and services. Goods, not services, goods, right? Largely goods, which are going to create an havoc and make our imported inflation very, very significant. Thank you, friends, for your time. I hope that you have understood what the problems are, and I'll come back and thanks for listening till the end, and I'll come back with a new video next time. Thank you very much.